Chris B, I'm talking to you. You pointed out something that I think intrigued so many of us, saying, Kyle, look into the Canadian six-pack portfolio, something I've never heard of before. Following that portfolio, is it really worth buying a total CAD ETF? Many of you know I'm more proponented toward ETFs in this current market environment because I don't know the winners and losers that are going to come out on the other side of this. So let a broad basket of stocks sort themselves out. And when the market takes major dips, I'll just buy into one ETF consistently, right? But a lot of you have been talking about ETFs. I think this is a very proponented conversation to be having in this moment. And the six-pack portfolio is something that actually is a book sold on Amazon. I think it was written by Argonaut here, and I found this kind of post that really breaks this down for us. And I just want to get right into this. For those of you that have never heard of it like me, you're going to find this really intriguing because for those of you who don't know, there's a thread kicking around here started by Humble Pie called the Argonauts 5-Pack, which housed my investment philosophy for owning a simple portfolio to beat the TSX index. As per the title, I have added a stock to make it a six-pack, if only because it's a catchier name. God knows six-pack, if you're a beer drinker here in Canada, pretty common term. But in the reality, the current six sectors have been rotated within the 5-pack over the years anyways. The portfolio is constructed by choosing one stock of each category. So the six-pack primarily takes into consideration these sectors: banking, railroad, telecom, utility, pipeline, and REITs. And we can see the stocks that he's actually picked, and we're going to actually break these down, take a look at them, because again, this post was from 2018, so we do have 5-year performance to see if these combined portfolio of stocks would do better than the broader market. Now, he does offer a little bit of further insight here that I do think is relatively relevant. I'm only going to point out one aspect of this, but he's like, I've also preached that it's easier to beat the TSX because it's such a bad index, over encumbered by financials and especially the cyclical resource stocks, something that my portfolio avoids. I've been running slight variations of this setup since 2011, and it has beaten the index every year since then, averaging a crazy 8% alpha with lower risk than the TSX. But he's also taking into consideration that this is during a time period of obviously lower interest rates, things like that. The market's changed, so let's see how it's still performing. He also offers an advanced allocation of 30% Canadian stocks with the six-pack, 30% US stocks like VTI or SPY, 20% gold, and 20% bonds and cash. This portfolio is not my way of allocating stocks. I do prefer just to have almost a 50-50 split between Canadian and US index funds at this current moment, but there's a lot of comments, questions. Everyone's going to have their own opinion. I just want to purely focus on this six-pack portfolio. So for those of you that don't know me specifically, I have dramatically outperformed the TSX. Honestly, the performance of the TSX to my portfolio looks like a joke. If I zoom my head out, you can see since 2014 when I started investing, the TSX is up roughly the TSX S&P 60 index, so the 60 best companies in Canada, similar to the S&P 500, it's only up 35.45%. I'm not sure if this takes into consideration dividends, but keep in mind most of my accounts are up hundreds of percents in comparison. Like, I've tenfolded the Canadian markets, and I'm going to tell you what I think you can do to continue to kind of get these returns, because I'm not proponently sure that this six-pack portfolio will do it. But taking a look at Royal Bank, in the last 5 years, it's up about 36.9%, again, not taking into consideration the dividends. So in the last 5 years, it's doing pretty well. And I just want to give you a baseline that if we take like XIU, the S&P TSX 60, it is up 38% in the last 5 years, not taking into consideration dividends. So we'll just focus on cap gains. Some of these stocks will outperform with dividends, obviously, but the S&P TSX pays around 3% as well. So over 5 years, you could probably pop on an extra, 15% return or so on top of that. But nonetheless, Royal Bank's up 37%. Toronto Dominion Bank, obviously, since it's been recently shorted and a lot of fear around it, it's down to about 15% total cap gain return over the last 5 years. Getting into some of the railways like Canadian National Railway, which I do think, did he not add one more bank stock like BNS? Yeah, so we forgot BNS. Let me just look that up real quick. BNS stock has definitely been one of the worst performing banks of the bunch. Over the last 5 years since that post in 2018, it's actually down 10%. So you're probably equal to par with the S&P TSX 60 when you take all the banks. But let's look at the rest of these, because obviously this is a built-out portfolio. So some of these, like the railways, will definitely make up for some of those losses. Canadian National Railway is up a whopping 71%. Canadian Pacific Railway up a whopping 116%. So this sector allocation definitely making up for the loss on the financial side of it. We got telecom like TELUS, one of my most favorited telecom giants, up 27%. The performance doesn't seem nearly as appetizing, but keep in mind you're getting about about 2% more in dividends off this company than you would the S&P TSX. So, you're probably at par with the extra dividends. You got BCE Bell, a little lackluster at 18%, but again, way higher, doubling the dividend of the S&P TSX. And then we got Rogers Communication, the lesser talked about telecom giant here. This one's up 16% over the last 5 years. Getting into the utility sector, Fortis, a renowned Canadian dividend stock here, currently up 41.59%. Great starting yield. This company's done fabulously well, so kind of following suit with, again, some of the, the railways. It's been a much better outlier. You got things like Amera in here, up 43.6%, doing incredibly super high starting yield here as well. Probably some pretty good dividend bumps throughout that time period. You got things like Canadian Utilities, only up about 11.1%. A little lackluster at best here. You've got things like TC Pipeline getting into the energy sector side of it, only up 6%. But again, these are more dividend-focused companies because, again, you're getting over 6.5% dividend yield currently. But again, even with the dividend, it's still lackluster in comparison with the S&P TSX. You got things like Enbridge in here. Enbridge, he had a different company name. You'll notice that we're going to get into some of the companies over 5 years that don't even really exist anymore. And the company that he had listed here was actually ENF, which was a proponent of Enbridge that ended up getting dissolved into Enbridge. But Enbridge is up 24.8%, whopping over 6% yield. This company's done, in line with the S&P TSX as well. But getting into it, you can take a look at some of these companies that he gets into in the pipeline, like IPL. This is a company that got bought out, doesn't exist anymore. It got bought by Brookfield Infrastructure Partners. So this is one of the companies that he picked. Doesn't exist, but since 2019, this company got bought out. So if we take a look since 2019, how would the performance have been? Just taking a generic time frame, it's up about 40%. So Brookfield Infrastructure Partners doing exceptionally well since 2019, so you could proponently replace that with that company if you decided just to keep the shares in Brookfield. But continuing on, we're taking a look at some of his REITs now, like Canadian Apartment Properties. This one up 26%, 3% yield. Real estate has been getting hit really hard. This would have been a huge outlier if it wasn't for the interest rate environment, but he does mention that in that article that in a lower interest rate environment, these stocks should proponently do well. In a higher interest rate environment, again, there's a little fear in infrastructure, telecom, all these heavy debted companies, they could start seeing a slowdown in revenue due to interest payments, right? So this one lackluster, probably about at par with the S&P TSX. He does mention another REIT called Canadian Real Estate Investment Trust, which is what a classic name right there, eh? REF-UN. Now, this is a company that disappeared also in 2019 that had pretty stellar performance up to that point. And it ended up getting bought out. I kind of just read through this, and it got bought out by Choice Properties. Choice Properties over the last 5 years actually been a pretty good performer. A lot of volatility with this REIT nonetheless, up 23% with a 5% dividend yield. So again, probably more in line with the performance of the S&P TSX. So what are my overall thoughts? Well, taking a look at some of the indexes here and just the general performance, again, you're talking around 50+%, just probably between 50 and 60% returns off something like XIU. You got the VCE, another one of my proponented ETFs that I'm thinking about buying. It's up, again, similar performance, 38%, 3% dividend yield here. And you can take a look at the total returns as well. I don't have the total returns off these stocks, but I'll make an opinion about it in a second. But you can see XIU total return would be around $16,000 over the last 5 years. VCE, just around the same, almost exactly the same. VDY, my favorite dividend ETF, looks like it's not performing as well, but keep in mind you're getting over an extra percent dividend. So we take a look at that total return, and you're around 15,600. So all of these are performing in line, give or take a few $100s, in exactly the same performance. So why is that, and what do I think about these combined stocks? Honestly, in this kind of market environment, I don't think buying these stocks are going to offer that crazy of a return, because you can see the ones that underperform, you're just going to end up getting a baseline. Now, I do think all these combined stocks are still outperforming, but I can't imagine that they're outperforming by leaps and bounds. They're not outperforming to the point where you're seeing this kind of a rate of return. I imagine you might be beating the index by maybe an extra 20% if you were lucky, combining all of these stocks. So is it really worth taking on the volatility, the risk, the buyouts, the constant changing in industry and management, where you could just buy these basketed in an ETF ETF and get, similar performance. So how do you end up getting this kind of return? Well, there's basketed companies that aren't included in here that I think are a huge detriment to people that want to outperform. I think if you're picking individual stocks, you want to beat the market by a little bit more than 15 or 20%. Like, obviously it's great, but I mean, you want to excel. You want to truly outperform over the long term. So how do we do that? Well, you're missing the most proponented part of this entire sector performance, and that is tech. I'm sorry, but over the last 5 years, if this just included the technology sector, taking a look at the two biggest tech companies in Canada over the last 5 years, even Shopify dropping, this wicked fall off, it's down 70%. Yet if you bought it 5 years ago when that article was written, you'd still be up a whopping 317%, which would dramatically propel your portfolio, considering the best performing stocks in his portfolio were railways, which are proponently great companies, the best one up over 100%, but we ain't talking about these kind of returns. Look at Constellation Software, up 205%, one of the best performing proponented Canadian stocks. Both of these companies have the real capability of overtaking the top largest companies in Canada, perhaps replacing things like Royal Bank and Toronto Dominion Bank. And it's just kind of crazy to me to think that, you're not going to be paying attention to these sectors when you want to kind of get better performance over the long term. Because again, if I'm going to take the risk of individual stock investments, I need to see way damn higher returns than an extra 50 or 20% over the index, right? And this is why when it comes to my portfolio specifically, I'm much more focused on US companies. Like, most of my money's in the US. The US will dramatically outperform the Canadian markets. They have historically, and I honestly think that the Canadian markets in the midterm here might actually outperform the US just because of our exposure to the energy, to things like the precious metal markets and commodities in general, which you get exposure to in the broader index, right? Now, obviously, I wouldn't put all my money just in the Canadian markets. That would be foolish. That's why I like things like SCHD, the Schwab US Dividend Equity ETF. I like the S&P 500 SPY or VOO. And if I wanted to try and outperform again, I would probably concentrate basically at this point at the scale of my portfolio. If I was younger, I would just buy individual stocks of where I'm sitting today. I want most of my money in those index funds, and I want to buy the indexes when they take major dips, which is what I've been doing. It's how I'm going to outperform the market, is just by taking advantage when the advantage is available to me. But outside of that, I could also and am also buying individual stocks that I think can outperform. So I'm just going to put most of my money, ETFs, 10% of my portfolio, in higher vector growth companies, things I'm doing with TSM. I mean, you could look at things like Apple and Microsoft, Shopify. I mean, these companies that do come with a little bit more risk, but are likely to outperform if you think the future and the current valuations make sense in the moment for you. That's just the way I would do it. I don't think you need to pick each best, like these large cap companies in each sector. It's something that I would have done when I was younger, but these days when you look at the performance, the volatility in the markets, what 10 years does when these companies get bought out, they might not even be around. Look at things like Algonquin Power and Utility that just got hammered in a high interest raising environment. It's just I'm starting to realize that the scale of my portfolio, again, may be different for you. It's just easier for me to buy the index and then use my knowledge base and my attention, instead of looking at 30 or 40 stocks, just look at 3 or 4 stocks, concentrate them a little heavier, and then just cost average for the rest, right? But I'll pass that question off to you. I'd love to know what you think. Fascinating conversation. Let me know down below.